It begins with chaos disguised as euphoria, silver touching new highs, headlines shouting record prices, people rushing to buy coins, old vaults reopening, everyone convinced they've finally found the real money, the metal that never lies. But that's the funny part about silver. It tells the truth, eventually. And that truth is almost always cruel to those who arrive late. Because history doesn't just rhyme in this market, it mocks. Every time silver explodes in price, it whispers the same warning. I've been here before, and it never ends well. So today, let's trace that echo. Because if you believe silver can't crash 50%, it's probably because you haven't looked close enough at the times it already has. Why this matters right now. In January 2026, silver hit $119 an ounce, the highest in history. Analysts are calling it a new era for metals. Social media says the dollar is doomed, and banks are already drawing their lines for the battle ahead. Marko Kolanovic, once JP Morgan's chief strategist, made headlines calling silver a textbook bubble, predicting it could fall by half within a year. Half. Now, that sounds dramatic, until you see how often it's happened. This isn't the first silver rush, it's just the newest chapter, written in faster money, with flashier screens, and the same old human greed. The 1980 lesson, when greed went nuclear. Let's rewind to January 1980. Back then, silver wasn't a meme, it was a mission. Two Texas oil billionaires, the Hunt brothers, tried to corner the silver market. They were convinced inflation would destroy the dollar, and silver, real metal, was the only defense. They borrowed billions. They bought everything in sight. At one point, they controlled almost half the world's deliverable silver supply. The price exploded from $6 to nearly $50 an ounce, an 800% gain. People lined up outside coin dealers. News anchors called it a revolution in money. Then the rules changed. Exchanges raised margin requirements. Suddenly, the Hunts couldn't afford to hold their positions. They started selling. The price fell faster than it rose, down more than 70%. That crash was so violent, the US Senate later called it the most significant market corner attempt of the century. The 2011 lesson. The digital rush turns sour. Fast forward to 2011. Fresh out of the 2008 crisis, investors distrusted banks, central governments, the entire system. Once again, silver became the symbol of rebellion, the poor man's gold. It climbed from $9 to $49 in just 3 years. The same parabolic curve, the same new era talk. And then, gravity, margin calls, a liquidity squeeze. By late 2013, silver was under $20 again, a 60% drawdown. Retail traders never recovered. Large funds bought the dip and waited. 2 peaks, 30 years apart. One constant: when silver feels unstoppable, it's already at its breaking point. What drives every silver bubble? Every cycle follows the same invisible script. Step 1. Panic about inflation or currency failure. Step 2. Rush into silver as the real money. Step 3. Leverage comes flooding in. People buying metal they don't actually hold. Step 4. Prices go parabolic. Step 5. Margin debt blows up, and the same panic flips direction. Silver's volatility is its curse. It's not just a safe haven, it's a mirror for fear. When fear peaks, silver peaks, and no emotion sustains that high for long. Inside the machine, how the system really works. Most silver trading isn't about shiny bars or coins, it's paper. Futures contracts, ETFs, derivatives stacked on top of each other. For every real ounce of physical silver, there are roughly 100 ounces traded on paper. That means the price most people see on a chart isn't determined by miners or jewelers. It's determined by leverage, liquidity, and the plumbing of exchanges like COMEX. So when liquidity dries up, even slightly, prices collapse. Not because silver changed, but because money did. That's what happened in 1980. That's what happened in 2011. And that's what could happen again in 2026. Here's where it gets uncomfortable. Today's rally has all the classic warning lights flashing. Parabolic charts. Short-term traders bragging about never selling. A wave of online influencers calling this time different. And yet, the fundamentals look eerily similar to past peaks. Global industrial demand is high, yes, but supply hasn't evaporated. Mines are reopening, recycling is soaring, and central banks, the real power in metals, quietly prefer stability, not chaos. Which means if silver goes too high, someone will eventually apply the brakes. And when that moment comes, it won't be gentle. Let me ask you something. Do you think silver's current rally is fueled by real fundamentals, or is this just history doing what it always does, testing how much optimism the crowd can handle before the fall? Drop your thoughts in the comments. Seriously, I read them. And if you want to understand how today's credit systems quietly control markets like silver and gold, subscribe now, because the next few months might expose the biggest financial mood swing of the decade. All right, let's peel back the layer everyone avoids talking about, the math. Here's the uncomfortable arithmetic. In 2025, the total value of silver traded on paper hit $20 trillion. Global silver mining output? Barely $20 billion. That means for every physical dollar of silver, there are almost 1,000 in synthetic exposure. So, when fear reverses, traders don't just sell, they liquidate leverage. That's why a small dip can turn into an avalanche. Every percentage point lost forces billions in margin calls. If liquidity thins, if banks tighten collateral requirements, prices don't slide, they drop off a cliff. That's what insiders mean when they say crash potential 50%. It's not prophecy, it's physics. The same thing that makes silver beautiful, its purity, makes investors irrational. It represents strength, trust, permanence, all while trading like a teenager on caffeine. People flee into it for safety and end up gambling. The irony never fades. And every time the crowd repeats the mantra, "This time is different," the math simply smiles and whispers, "It never is." The 1980s crash reset commodity speculation for decades. The 2011 collapse buried an entire generation of silver enthusiasts. And now, in 2026, we're seeing a digital age repeat at algorithmic speed. The same emotional script, compressed into months instead of years. Charts rise in vertical lines. Forums glow with confidence. Analysts warn and get mocked right before they're proven right again. It's history on fast forward. Silver always burns brightest before it burns investors. If silver falls 50%, it'll likely happen quickly, 2 or 3 brutal weeks. A liquidity shock triggered by rate changes, ETF liquidations, or margin limits. Physical coins may stay scarce for a while, giving a false sense of strength, but futures will dictate the collapse. Those who keep leverage, wiped out. Those holding physical long-term, hurt but alive. Those who remember history, prepared, because every cycle punishes speed and rewards patience. Here's the absurd part. Each generation repeats the same speech. This time it's different. Then the crash hits, and the survivors say, "Well, that escalated fast." And somewhere, An old trader, probably retired in Florida, sips his coffee and mutters, "It always does." So maybe the question isn't, will silver crash 50%, but how many people need to believe it can't before it does? Because silver's greatest strength, its reflection of human fear, is also its greatest weakness. It mirrors us, our optimism, our delusion, our panic. And if history has taught anything, it's this: every silver rush ends not with thunder, but with silence. A silence where charts are flat, miners lay off workers, and everyone swears they'll never touch it again. Until the next time. Because in finance, memory fades faster than money. And silver, beautiful, untamed, unforgiving, will always find a new crowd ready to believe the lie that this time it's different. See you in next video. Thank you.